The Fed breaks housing over and over again. Watch the Fed. They're the ones that are screwing you out of cheap homes and affordability.
Welcome to the Anton Standard Podcast. Last week, we talked about why prices haven't crashed, but this week, we're answering the question why prices won't crash like in 2008. Because everybody's wanting some cheap real estate deals, but they haven't been coming, and they ain't coming anytime soon. So what's going on?
Well, I want them too. Okay, so that's the part that everyone needs to understand. And why are we doing this? Everyone believes it's going to crash. We feel like it should crash. Our emotions are telling us. And so I want you to ask yourself as we go through some data and we give you an unbiased opinion, I want you to say, what does it feel like? Does it feel like it's going to crash? Does it feel like it's 2008? What is the media telling you in relation to this? Or is it time to stock up on guns and gold and food because it's over? And we've got wars and we've got natural disasters. And so it's a little bit scary right now. Plus, you've got this crazy presidential election that's heating up in the background. So the goal here, though, is let's give you some data. Let's talk through what's happened. Let's talk through where the future is taking us, and then let everyone else decide. So really, Benji, I think it starts with what caused the Great Recession. So there's probably more factors than this, but I just want to pound through real quickly, what caused the Great Recession? So we know subprime mortgage lending was one of the big one. Did you see the Big Short?
Yes, I did.
If you haven't seen that movie, it's worth watching. It's an entertaining look at the subprime mortgage market. Moral of the story is we gave out a bunch of money to buyers that didn't qualify and created a whole new class of debt. And that's one of the major things that caused the collapse. What caused that collapse was then the housing bubble specifically burst. And this was a domino that turned into another domino that turned into another domino. And the U.S. economy took out the world, during the great financial crisis. It put a bunch of homes underwater, and then new construction permits fell off the side of a cliff. So, for some context, we were building a long-term average of 1960 to 2000 of about 1.5 million homes a year. And in 2005, we peaked at 2.15 million housing units being built. Then all of a sudden, the great financial crisis happens and permits drop to around 900,000 in 2007, and they hit a historic low of 500,000 in 2009. So we went in, we're building a whole bunch of homes. We peak out at 2.5 million. Boom, it drops to less than 500,000 during the great financial crisis. Well, what happened to real estate transactions? Home sales during the early 2000s started to surge because of easy credit, lower interest rates, subprime mortgages. In 2005, we peaked at over 7 million home sales. We still have not gotten back to the 2005 level today. So even in the mayhem and craziness of 2022, we didn't pass 2005. I think most people forget that. We were within striking distance, but we still didn't pass them. The historical average before that was 4.5 to 5 million homes. After that, in 2007, when things started popping, 2007 was a little over 5 million. And then by the end of 2008, we fell to 4.1. Guess what? We're currently selling less homes right now than we were then. But what's happened to prices, brother man?
Gone up.
Prices have gone up. Prices haven't substantially changed just because of transaction count. That's one of the things I want you to be, taking into consideration. But what happened to home prices during the great financial crisis? So home prices, so we're going to talk nationally. Now realize in these national numbers, though, there are places in the U.S. that only saw a 5-10% decline. Then there are places in the U.S. that saw a 50% decline. So nationally, according to the Case-Shiller S&P Home Price Index, we saw a cumulative drop of 30% from the peak. So the peak was 2006, and to the trough in 2012, there was a 30% drop. Once again, these were just dominoes bumping into each other. What was one of the other factors? Mortgage-backed securities. What are mortgage-backed securities? Mortgage-backed securities are where banks bundled giant groups of assets and securities together and sold them to other banks. What happened was their loans, they massively declined in value. And so all of these loans started coming due, and the whole basket of mortgage-backed securities started falling apart. One of the things that really led into that was not only the subprime, not only the mortgage-backed securities, was the fact that the credit agencies put together good debt, AAA debt, but it wasn't AAA. They fudged on it. So Moody's and Standard & Poor's, what they did was they gave AAA credit rating to pools of debt that had those subprime mortgages inside of them. And those subprime mortgages should have downgraded the debt. But it was the heyday. Everyone was doing it, so they said, you know what, that's AAA. Below the surface, we started coming up with these financial instruments called credit default swaps. That's a financial derivative where banks intend to protect themselves against debt defaulting. So they borrow from each other and they bet on the debt not defaulting. The problem is when the whole thing turns into a house of cards, and it was all packaged together, and it was all rated as perfect debt when it shouldn't have been perfect debt, and then they were betting against it never failing, it eventually started failing, and it caused that tsunami of debt. And once again, we took the globe out. The U.S. took the globe out. Then we had major financial institutions fail. So we had an unbelievable amount of banks fail. I want to say something like 3,500 banks across the U.S. failed. If I'm wrong, someone hit me in the comments and just tell me the exact number. When you look at it today, though, they go, financial institutions are failing. It's 2008 all over again. We haven't even had hundreds of bank failures. In the great financial crisis, we had thousands. This was one of the major problems, though. So we had regulation relaxation. The government agencies that oversaw financial institutions, what they did was they allowed financial institutions to take more risk. They backed off and they stopped their practices that mitigated risk. Part of this also was due into the fact of the government changed part of their housing policies. So it was called the Community Reinvestment Act, which was a policy aimed at promoting home ownership. This was Republicans, this was Democrats, everyone was to blame. So it's really funny how everyone points the finger in hindsight. But what it did was it encouraged us to get unqualified buyers into homes. So this was a house of cards, built on a house of cards, built on a house of cards. The government's not checking on everyone. And then we've got policies from the government saying, you know what, we need to increase home ownership. All the while we're getting excess leverage. And what I mean by that is the financial institutions are operating with higher levels of debt due to less oversight. The consumer is operating with higher levels of debt due to less oversight. So what'd that lead to next? It led to excessive overborrowing. Okay, so I'm a builder developer and I'm just getting started because I'm a young kid and it's 2005, 2006. And I get my first lines of credit.
$1 million.
$500,000. And I think I died and went to heaven. I have 2 unsecured lines of credit. And so I'm using them like weapons of mass destruction, and that they should have probably never given to me. But that's just an example because, see, in a land development project in the early and mid 2000s, so I started real estate in 2003, you could borrow at 100% LTV. That's 100% loan to value. That means there's no juice left in it. Today, it's 75% loan to cost. So it means there's 25 to 35%, sometimes 45% more cash in the deal. So this was, the financial regulators are allowing it. The government's promoting it. So what do? We get into the heyday. But then what also happens? The global trade starts getting even more imbalanced. We get large trade deficits in certain areas. The US becomes more of a consumer-based economy. The Fed really starts to screw this one up. And this is where, as I was doing the research for this podcast, before we recorded this, I was like, holy cow, the Fed, it was like a combination. Banking, greed, and the Fed broke our housing market. And that's what did it again and what's doing it right now. But the egg's not going to crack the same, even though it's already had some cracks in its foundation. So in the early 2000s, what the Fed did to stimulate the economy was they started lowering interest rates and creating low interest rate monetary policy. And we'll dig into that a little bit more. Then a shadow banking system started to emerge. So what this is this is kind of like there's a parallel banking system where we've got investment banks and other financial entities that are leveraging capital, private equity, but they don't have the same oversight as a traditional bank. And they're building and becoming stronger in the background. Locally, we had a bank that sprung out of a warehouse line of credit. So these guys went and got a line of credit. That line of credit by the mid-2000s grew into a $5 million line of credit. That $5 million line of credit turned into one of these shadow banks, and then they actually became a legit bank. Then they were so over-leveraged, I won't say their name. We did business with them. Everyone did business with them. And then, boom, they sank and went under, but they started out in this shadow banking system. The last thing there's more. We started creating more complex financial products. Okay, this is what I mean. Collateralized debt obligations. I don't even really know what that fully means. It's called a CDO. This stuff started really popping out where we're creating new instruments for the rich to get richer and for Wall Street to pass more risk on to other people. The problem started, though, when energy started to get out of control. And we had fluctuations in specifically oil prices. So from 2003 to 2008, oil prices surged and peaked at $147 a barrel in 2008. This was in connection with the Great Financial Crisis, but it was also in connection with our trade imbalances. It was in connection with the second Iraq war. I forget which one we called that. And the problem is the consumer was so indebted that as the cost of energy started rising massively, it just crushed us. Where are we at today? Energy is not as expensive today. Oil is flowing a lot better. Even with this global conflict, we still haven't seen oil hit, $147 a barrel. Okay, we had some major technology changes happen. We had natural disasters. So people forget, like Hurricane Katrina in 2005 was a major contributor to problems in our economy, causes massive insurance losses, caused massive government spending, caused the federal deficit to start ballooning. The Iraq war from 2003 to 2011 was one of those geopolitical tensions that caused that oil spike. And then just kind of one of the final nails in the coffin, some of you may remember this, was we had the pandemic risk starting to show up in 2008 with H1N1, aka the swine flu. Everyone's going to die of the swine flu. So this is how the Great Financial Crisis got set up. So when we're looking at what we're going to compare next that's the Great Financial Crisis, but I want you to ask yourself, how does that look relative to today? So does this look, when we talk about these things, is today better, the worse, or is parts of this similar? What are you thinking?
Well, I know what most people do think. the financial crash and real estate price drops happened because housing got unaffordable. Even beyond the price of the homes when that went up in 2007, they were already not qualified.
Yeah.
So you combine it with high prices, not qualified buyers. Well, to a certain degree, it's the same. Really high prices. And even though they do qualify, it's unaffordable compared to how much they're making and how high inflation has gotten, even
Yes.
though it's slowing down.
Yeah.
So to me, that's why we all think that, hey, it's inevitable that there's going to be a crash or a correction, because those two elements are maybe top of mind for most people.
I 1000% agree that that's top of mind for most people. And I want to let all of our listeners and subscribers know I understand how you feel. I would say the majority of people agree with you. The data, though, says that in going into the great financial crisis, somewhere between 20 to 30% of the home borrowers didn't qualify. So that's what got us to those 7 million plus transactions, because of the ninja loans, the no income, no job, no documentation. So we technically borrowed a certain percentage of buyers from the future and forward pressed that demand with relaxed government regulation, with relaxed lending standards, with subprime lending. So it was like everyone was drunk and playing on their credit card all at the same time. And of course, prices shot up. Ask yourself this. If you've gotten a loan in the last 10 months, 12 months, 24 months, did the lender put you through the ringer for any loan?
Probably.
The answer is yes. So today, even though it's unaffordable, I will really agree. Remember, in our previous episodes, we've talked about how this is the second most unaffordable time in the last 40 years since the early 80s. So I get the unaffordability part. We're not discounting that. And yet the buyers are qualifying. Well, where is the pain then showing up? The pain is massively showing up in the low transaction volume. That's why we were below 4 million. That's why we were selling less homes than we were in the great financial crisis. So even with unemployment higher, with less jobs, no one had any money, the government going, oh crap, we got to turn on the money printers. We sold more homes than we were today, because that's part of that unaffordability. And what we're going to go through is we're going to talk about like how the Fed really broke housing and how they contributed to that problem. So I want to walk people through, and you can kind of think of this as like part 2. I want you to focus on banking and the Federal Reserve. And just think about this for a second. It's 1999. It's a good year. It's the late 90s. Fed's fund rate, 4.75. Okay, sounds pretty high. That's basically what it is today. 2000, Fed's fund rate peaks at 6.5. Why? They were trying to cool down the tech bubble, tech mania. In the late 90s, what I did with my dad, so I graduated high school in 1996. My dad and I sat down at our gateway computer, the little cow print, and sat there and said, how are we going to get rich buying tech stocks? And in the late 90s, I spent, I think it was $2,000. I spent $2,000, and I think he spent like 10 or 20. And we both just made these bets. And then all of a sudden, over the next, and I want to say that was like 98, and like 98, 99, 2000, we're like, oh my goodness, we're making a ton of money on this. And then the tech bubble popped. Well, why did the tech bubble actually pop? The tech bubble popped because the Fed raised rates so high. See, the Fed's the master manipulator hiding in the background, pulling these strings that people, oh, it was all real estate. Was it? Or was it the Fed? So, .com crash. Oh my goodness. And then, we have the horrific events of 9/11. Okay. So the Fed then lowers the Fed funds rate from 6.5 to 1.75, and they basically remain low. 1.25, 2.25 in 2004, and then the Fed started raising rates again in 2004 because they said the economy's heating up. They continue hiking in 2005, 4.25. Uh-oh, here it comes. 2006, the Fed fund rate reaches 5.25, where it remains until the summer of 2027. So did housing pop, or did the Fed cause housing to pop? I'm just pontificating on this, but the Fed saw the economy overheating. They saw inflation rising, and so they were the ones controlling this string. I don't think they meant for the great financial crisis to become the contagion, the outbreak, and take out the world, because I don't think they understood how weak the banking sector was and how over-leveraged and how much bad debt there was. But realize the Federal Reserve did this.
What is the Federal Reserve rate right now?
5.
5.255.
Yeah.
So they're basically backing off before any crash is about to happen. So wouldn't you say that what Papa Powell is doing is the right thing?
Oh my goodness. Bro, he just backed me into a corner. On camera, I'm backed into a corner.
Based off of what you're saying, right? Because he's like, hey, if we're going to avoid what's happening in 2008, set aside real estate, what the reality is there, shouldn't we just drop them now before this happens?
Okay, let's look at this from a couple different angles. So one, that was an amazingly powerful question. I give you mad props. 2, it would appear Papa Powell is doing the right thing and headed towards the soft landing because labor appears to be breaking. And if you break labor, our whole economy breaks. So you have to slow down the tension by easing monetary policy before labor breaks. Because if labor breaks, and here's what I mean by that, if unemployment rises drastically, then the economy goes down the tube, because that's what you saw in the great financial crisis. So theoretically, they are doing the right thing and getting ahead of this. Will Papa Powell be able to stick the soft landing? Don't know. Are we going to have a no landing? Don't know. Are we going into a mild recession? Don't know. But I don't think we're going into a super hard recession. And I don't think we're going into the great financial crisis. And it looks like home prices are not going to massively crash because they didn't already crash during the massive drop in transactions and the highest rates since the 1980s. If they would have crashed, it would have already crashed, because they came down in 2022 and they've started rising again, and now they're lowering debt. Real estate went through a transaction recession. Now we're getting ready to go back into price rising. This is that rolling recession we're talking about. We already got hit. Our time is over. So for our investors who are really paying attention, our savvy buyers, once again, this is your buy signal. Not necessarily financial advice, but I'm spending my own money. This is your buy signal because the Fed's lowering rates. And if we look back through history, as the Fed lowers rates, real estate transactions pick up and prices increase. You look like you want to say something. What are you thinking?
Oh no, I'm just thinking, okay, well then on the flip side, say they didn't lower rates. Say they kept them the same, or maybe even up them even more, because technically we're not at the 2% inflation target of the Fed. Part of them raising rates is so that inflation gets back on track. Well, wouldn't you say there'd be less buyers and homes would just not sell?
If the Fed kept rates high?
Kept rates high, yeah, or even went higher.
Well, we've technically already been higher.
Yeah.
So if the Fed went higher, transactions would probably go back to a run rate under 4 million, which we've already shown. So let me actually give this a range. If rates are over 7%, prices can decline. The Fed funds rate needs to be about 5.5% or higher for us to have rates over 7. As the Fed lowers rates and rates get in the mid sixes, which is where they are today, I believe you have price stabilization. As the Fed lowers rates and rates get towards the low sixes, you have slight increases. As rates get below 5%, below 6% into the fives, you have an increase in prices, increase in price velocity, let's call it. As we enter the low fives, expect an unlock in inventory to start and to price velocity to increase even more. So it's going to depend on the rate at which the Fed lowers it based on, the totality of the data. But let's give our listeners a golden nugget. Let's nerd out with them for a second. CPI just came out. Okay? It came out literally yesterday. It hit expectations to the high side, and all the news media comes out and says, inflation's running hot, core CPI is running hot, the world's going to hell in a go-kart. Come on, people, slow down. Read the data. Review what's happening. We've talked about this before. Go 3 layers deep, figure it out. Cool, you go and dig into it. What does it actually say? It's showing that housing in there, which makes up over 30%, almost 40% of the index, because it's looking at a 12-month run, is still running at about 5%, specifically rents. Anyone listening to this right now, do you know of anywhere rents going up in the U.S. by 5%? And the answer is going to be no, because it's not. Because rents are flat and slightly declining and barely going up in some metros. But the way inflation is calculated is an old metric where they take every month over 12 months. And so because of the trailing data, it's making CPI look hotter because you had a bigger boxcar full of more goods and services come through. So if we just went and looked at actual rents last month and backed it all the way out, what do you think inflation actually is today? Today's actual rate of inflation, if we take out the archaic way of looking at owner's equivalent rents and rents over 12 months, what's the actual real inflation today?
Maybe closer to 2.
Below 2%. Depending on how you measure it, it's literally like 1.6 to 1.8. We're at the freaking Fed's target.
But couldn't you say that it's like that because we got so high? It's like a balancing out.
Yes.
Because we're supposed to go 2%, 2%, 2%, 2%, 2%, 2%. But then we went like this. Just like we're stealing homeowners and home buyers from the future. Yep. We're basically stealing inflation from the future. And so even if it's going back down, it's just like a balancing out of that little hump.
But this is where people get this confused. Inflation is the rate of change of prices. Mm-hmm. It doesn't affect the actual price. So it's just a slowdown of the gain. Prices are still freaking high. Everything's still super expensive. What it's saying is price growth is slowing down. Mm-hmm. What the main thing I want people to hear, though, is that inflation is already below 2%. So Papa Powell's making the right move, which means home prices are headed in an upward direction based on history. Okay. So the Fed breaks housing. We go into the great financial crisis. Then what do they do? The Fed goes, oh my goodness, we got to go to 0. So it's 0 in 2008 to 0.25. It's basically 0 to 0.25 from 2009 to 2014. 2015, the Fed goes, oh man, we should raise it. It goes up to a max 0.5%. And then in 2016, it's 0.5% to 0.75. That is known as the ZERP era. The ZERP era refers to this kind of policy where the Federal Reserve maintained a zero interest rate policy, ZERP, between 2008 to 2015. Well, what did that do to all assets?
Zero interest rate policy. That'd be a good name for this era.
The ZERP era is literally what it was called because the Federal Reserve they were like frat boys. They were throwing keggers all the time, and they mistakenly believed that they needed to keep interest rates super low for a period of time. So it was literally like 2008 to 2015. What that started causing was massive speculation because debt was so cheap. That speculation really started causing home prices to rise, asset values to rise. And the idea, though, was it was supposed to power us out of the great financial crisis. It was to boost lending. It was to stimulate the economy. It was to encourage borrowing, to encourage businesses to borrow. What it really did was it encouraged massive risk taking on both the consumer and corporations. But then, like all good parties, sooner or later you're too drunk and you're starting to get hungover and problems are starting to show up. So the Fed starts raising rates. Why? Because inflation was rearing its ugly head. So inflation starts rearing its ugly head and the Fed starts raising rates. So in 2017, they go to 0.75. And then by the end of 2017, they're at 1.5%. 2018, they're 1.75 to 2.5. And then in 2019, they get to 2.5, but the problem was this. Third quarter of 2018, I remember this vividly. You know what's happening in real estate? The market is massively slowing down. And see, only the super nerds, our subscribers, our people, our customers who are always hanging out with us who are talking about this are seeing this. I'm going to all the agents on the team and in the brokerages, and we're saying this. Hey, by the way, transaction count is dropping. Prices are like flat and declining in some things. Why? Because interest rates had shot up so much. The market was literally shutting down because of this little blip. So what happened in 2019? They had to cut rates. We were literally going into a recession because the Fed was raising interest rates, because we were addicted to the ZERP. It was like the purple ZERP. And so all of a sudden, and this is where your conspiracy brain kicks in. You go, wait a second. We avoid this recession because the pandemic happens next? Weird. I mean, just could be a coincidence or, maybe. So all of a sudden the pandemic happens. We have this global pandemic and we've got to go right back to ZERP. And we go back into money printing to stimulate again. The problem then, though, is that inflation problem that was starting. Its embers were showing up in 2017 and 2018. We just reignited them because the global pandemic shut down the supply chains. Everyone went home for a moment. We gave them all helicopter money. And then everyone started spending and inflation shot through the roof. So the Federal Reserve had to respond. Well, what did they do? This is where you should be getting my thesis. The Fed breaks housing over and over again. Watch the Fed. And they broke it permanently. They're the ones that are screwing you out of cheap homes and affordability. We'll get into it specifically with the new construction numbers, but because they broke housing, they killed off new construction, which killed off the supply. That lack of supply is what's going to keep prices higher for so much longer than what people want. So in 2022, we hit 4.25. And in late 2022, you saw prices decline. But then what happened in 2023? In the face of the Fed still hiking, prices stabilized and they started climbing again. Of course, then we saw the Fed funds rate peak in 2024. And now we've already seen its first cut. Generally speaking, once the Fed starts cutting, just go look back. Once we start cutting, it's just on its way down. What's happening today, though, is because you called and asked me this, so I want to address this, and this is a good spot to do it. You said, bro, what's happening with the 10-year?
So the 10-year interest rate, the Treasury, the 10-year note that the Treasury puts out is basically what all money is kind of based off of in terms
all of our
borrowing,
real estate debt,
right?
Yeah.
And that has been coming down, which in turn mortgages have been coming down, right? The interest rates, Well, it went way down to like, I don't know, 3.25 or something like that.
Yep, low threes.
Yeah, low threes. And within just the last week or two, it's skyrocketing over 4.
Yeah, vertical.
Yeah. And
Vertical.
so I woke up this morning because I am a geek and I check the 10-year Treasury every morning. I'm like, wonder what's going on here. And that's why we're sitting here. Because if that is going up as Papa Powell is lowering the rates, there's a conflict there.
There is.
And why is there a conflict? Why is the interest rates at the Fed going lower, but the Treasury 10-year is going up?
This is a phenomenal question. And only the hardcore investors understand this. And this is something that you need to pay attention to. The market moves on the rumor, not the fact. Okay? So, did anyone ever spread a rumor about something in high school and all of a sudden you're dating 29 girls and, you're in trouble for something you didn't do? Okay, the same thing happens in the stock market. We trade the rumor. So what was happening is coming up to the Fed's cut, the market is pre-pricing in the rumor. They're betting the rumor's going to happen. Well, what does the stock market always do? They always overbet. So they overcompensate for what's getting ready to happen. So the half point, quarter point, they baked in more than that right up front. Then the Fed actually surprised us. The market was baking in a quarter point. They gave us a half point. And then rates rise right after that. That actually always happens. The reason it happens is, once again, there's rumor and then there's fact. But the Fed does also not directly control the 10-year. We did a whole other video about the factors that affect interest rates that you guys can go watch. That'll explain this at a much better level. But what happened was, or historically speaking, I should say, it always rises right after the Fed cuts rates. And it pops back up, and then the market realizes, okay, this is comfort, and then it slowly ticks back down again. So as long as it doesn't have more than a 50% retracement to its previous level, so think of it like a J. If this is its previous level and it comes about 50% back up, what it will do is it'll hit a support, and then it will naturally continue in a downward direction. If it goes above 50% of its previous level, expect it to possibly establish a floor and then move up from there. So most likely, this is going to bump against this little ceiling it's currently hitting right now, and then it's going to slide down again. Now, there were other factors that came into that. We had some jobs data that came out that blew expectations out of the water. Once again, in my opinion, over-exaggeration. Where did all those government jobs come from? Like, come on. It said there were hundreds of thousands of college students employed. Show me hundreds of thousands of college students that are employed. So once again, I always like to dig below the surface. So we know that's coming down, but today, because interest rates went from 6.1 to 6.7, okay, that's how high they jumped on the 30-year fixed debt. Well, what's that do over the next few weeks? Pinches it, slows the buyer down, slows the demand down. So what do our buyers do? Go, 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 go. Okay, you can reach us at resg.com because we're telling them this is a buy signal. P.S., it's going to get cheaper over the next 45, 60, 90 days anyway. Let's go put things under contract. So generally speaking, the market pre-prices in the rumor. The event actually happens. Boom, it pops up, and then it kind of just slowly floats back down again. And it will do it again in November, and then it will do it again in December. Once the Fed starts, we're tracking down, though. We're going into the difference between the great financial crisis and today. Inflation, item number one. Did we have inflation during the great financial crisis? Like, do you remember inflation?
I don't think we had any inflation at all. In fact, if anything, prices generally came down.
We had some deflation during the great financial crisis. So
this is like 2008 to 10.
Bingo. Yeah, 2008, 9, 10. So during the great financial crisis, no inflation. Matter of fact, we were worried about falling prices. That was part of the reason we got into the ZERP, was to stimulate the economy, because there were sectors in which prices were falling. Where's inflation today?
It's stable.
Stable, but where was it? Just
Really high.
bingo. Inflation's like the boogeyman today. Okay, so we've been doing everything we can to put that out, to put that fire out.
It's because my Wagyu steaks are expensive, of course. We got to get that puppy down.
I had the best Wagyu tacos in this bougie Mexican restaurant in Scottsdale. Oh my goodness.
Bet it was expensive.
They were stupid expensive little tacos.
Come on, Papa Powell.
Yeah, I know.
Sounds so bad. We're complaining about Wagyu being too expensive.
So inflation, it's the 2000s, 3.4, 2001, 2.8, 2002, 1.6. You can see we're low, right? All of a sudden, remember, we told you he started raising rates. Why? 2004, it was 2.7. Oh no! 2005, inflation hit 3.4. So inflation rose significantly. Why? Higher energy prices. Okay, we talked about how the oil prices were coming up. Hurricane Katrina. All of a sudden, it's 2006. Inflation continues to put pressure on us. Plus, the housing market is burning out of control. Remember, we're trying to do that 7 million transactions. We're trying to keep up with that. So the Fed's raising rates to compensate for that. Well, okay, then what happened after that? 2008, 3.8. And then all of a sudden, super low, basically below the Fed's target from 2009 to 2016. That's why we had the ZERP. We were below the Fed's 2% target, so they had to stimulate. All of a sudden, except for there was a bunch of stuff that happened in 2011, which made us pop up to 3.2. So post the great financial crisis from 2008 to 2015, inflation was 1.9%. Next, government stimulus. So how do you think government stimulus was back then relative to today? I know we've talked about this multiple times.
I mean, it was a lot back then. We thought it was historical, but it's nowhere close to what it was in 2020.
That's exactly it. So during the great financial crisis, I remember having a conversation with my dad, and my dad grew up a farmer, so, fiscally conservative. Dad, they're spending, I think, over $1 trillion, maybe $2 trillion to bail us out of this. My dad says, that's too much money printing. We're never going to get out of this. My great-great-grandkids are going to have to pay for this. I can't believe how much this is probably going to stimulate the economy. So we had TARP, the Trouble Asset Relief Program. They authorized $700 billion. $475 billion was approximately spent. We had the American Recovery and Reinvestment Act, $831 billion. So between TARP and ARA, the American Recovery Reinvestment Act, the government spent $1.3 trillion. That $1.3 trillion plus ZERP contributed to the longest bull run in one of the best housing markets that lasted over a decade. Brother man, and I know you may remember this from our previous episodes, how much money have we printed when we, during and post COVID? Don't look down at the notes.
A lot. More than 2008 to 10. We've
Printed almost 5x that. Actually, almost 6x that. So the U.S. government's $36 trillion in debt. 5.2 in COVID relief increased the money supply by 27%. That was on top of 4.5 trillion in quantitative easing, another 2 trillion in infrastructure, which was 13 trillion in new money, or a 35% increase in the money circulation, or 60% of our GDP. So I want to ask you, listeners, subscribers. If you're not subscribed, hit the subscribe button, and thank you for hanging out with us. But if we printed 13 trillion this time, how much are assets going to go up over the next decade? We're going through the great melt up because of this money printing. We saw how much, I want you to go back and look at how much homes rose from the bottom. Just go like 2012 to 2019 and go, how much did they rise during that area? And now look at COVID and see how much more they rose and go, guess what? There's still more money in that system. That's part of the reason they're going to continue to rise. Unfortunately, I don't like this one, but we have to compare the wealth gap between the great financial crisis and today. And I believe we need to do everything humanly possible to go back and strengthen our middle class because this wealth gap is widening. This is the tale as old as time. So during the great financial crisis, the rich got richer and it eroded the middle class. What do you think happened today during this COVID era? Like, how bad do you think it is?
Worse.
I know, but like, pick a number. How much did the top 1% grow their wealth in the last 3 years?
Just a guess. I'm going to say 12 trillion.
He's looking down at the notes. The top 1% grew their net worth by $12 trillion in 3 years. The top 1% hold 34% of the total U.S. wealth, and they saw a 32% increase in 2022 up from 2019. So their wealth grew by a third. So one of the things I want you to be thinking about is we got this 13 trillion. This 13 trillion, what's really happening is, yes, it went into corporations and yes, it went into people's hands, but where it's actually ending up is in the 1%'s hands. And where we took it from was the middle class. And where it's hurting the most is the middle class. And then inflation is then destroying the people who have the least amount of money. That's the worst part of this. So the key factors in that wealth, I mean, it's not surprising. Stock market, real estate, and then tech. Those were your three biggest factors and wealth drivers during COVID. Next, we saw just a change in the U.S. We saw that kind of great migration, the remote work, the Zoom worker. So where was unemployment during the great financial crisis?
It was really high.
It was really high. It was hard for everyone to get a job. Unemployment rate peaked at 10% in 2009. Okay, now let's forward to today. So during the Great Migration, we had people move all across the U.S., and we had these Zoom towns. The top 5 metros that gained the most people, the Zoom towns: Austin, Texas; Boise, Idaho; Phoenix, Arizona; Tampa, Florida; Nashville, Tennessee. They saw 3%, 4%, 2.5%, and 3% growth over a 2-year period in their population. Huge. Their home prices shot up between 30 to 50% during that same timeline. But, and we're going to go into the unemployment number here in a little bit. Some of these are now the same cities that are now getting hurt in the price changes. So next, what happened to consumer confidence? I'll be honest, if you remember the great financial crisis, consumers were not confident about anything. There was a little bit of hopeless. There was a couple times because we own real estate brokerages. We literally had to tell people like, "Hey, you can't drink in the office during the day. No, you can't have a fridge in your office with booze in it and drink during the day." Like, I get it, the market's hard, and I get it. Consumer confidence is down. It literally showed up. I had other friends who were like, man, I'm never getting a job. I was like, what do you mean you're never getting a job? My second child was born. My pregnant wife had to go work in a restaurant so we could pay bills because we were so pinched. So consumer confidence in early 2007, and these numbers don't really mean anything, but it was around 105. In 2008, it averaged 58.5, and it hit a low of 38.8 in October. So the consumer thought the sky was falling. In 2009, consumer confidence averaged 45. 2010, and all of a sudden it starts to pick back up. Moral of the story is consumer confidence was very low during the great financial crisis, especially during the recessionary parts, and it started growing after the 2010. But during the pandemic lows, realized consumer confidence never got that low. And consumer confidence today, even with inflation concerns, is still super high relative to what it was. And consumer confidence right now is still super high. So what I'm saying is, in our consumer-based economy, our consumer still feels so much better than the great financial crisis today.
How do they measure that?
It's a survey. They literally connect with people.
On a piece of paper?
I actually don't know. You know, it's government.
I wonder if less people are filling it out.
Well, hold on. This is one of those good ones. How is consumer confidence measured?
Consumer confidence is typically measured through surveys that ask consumers about their perceptions of the current and future state of the economy, as well as their personal financial situation. Here are some of the most common methods used to measure consumer confidence. Surveys. The Conference Board's Consumer Confidence Index. This index is based on a survey of approximately 3,000 consumers who are asked about their expectations for the economy, their personal financial situation, and their plans for spending.
It's a survey.
They were in downtown Seattle next to Amazon headquarters.
But so they go ask approximately 3,000 people how they feel. And it's not a large data sample, but they've been doing that survey for so long, it is a decent barometer. It's not going to tell you the exact weather, but it tells you the way the wind is blowing. Next, supply chains. Okay. What happened during the great financial crisis? Did we have problems with supply chains?
Yeah, ships were out to sea just waiting.
No, that was...
okay, got it. Yeah. No, during the great financial crisis, I don't even remember.
We didn't have supply chain problems. We had an oversupply. And then, you know, during the pandemic, yes, we had ships waiting. Our supply chain broke. So that breaking of the supply chain caused prices to hold itself up artificially. And arguably, parts of the supply chain are still not fully back in line with where they were. And then secondly, what's long-term inflationary and what'll keep prices stable and higher for longer is we're reshoring things to the United States now. We're bringing certain manufacturing home. That forces home prices to stay higher. This keeps more money here instead of going to other countries to support them. What happened in the stock market?
Well, first it went way down.
It crashed.
Way down.
Yeah.
And then it slowly started going up consistently.
Bingo. The stock market peaked, and then it dropped 57% from its peak in 2007 to its lowest point in March of 2009. The S&P 500 did not fully recover until March of 2013. So 5 years for it to recover. What happened during COVID?
Skyrocketed up. Same thing, crashed, and then boom, up.
It only dropped 34%. We shove a bunch of money into this system. Boom, rebounds in just 5 months and recovers all of it. As of 2024, the S&P 500 is trading 170% higher than the low in the during the great financial crisis, and 90% higher than March of 2020 COVID low. What I'm illustrating to you and what I want our listeners to understand here is this is the Fed. This is the money printing. the cheap debt and the money printing is showing up in the asset value, which is keeping another asset class, real estate, its value propped up. One thing we're starting to worry about was climate change, okay, and housing. Al Gore's running around. He's telling us, climate change. There's people on both sides of the fence. Some are like, I believe. There's other people that are like, no way, he's an idiot. What is he talking about? As I looked around, I was like, I think the climate is starting to change. And, I went to school, studied the sciences. I got a little tree hugger in me, even though I'm definitely capitalist. You got to save the environment. And you're like, things are getting worse. Now, today, all of a sudden, we've had some of the craziest forest fires over the last few years. You've got beachfront property that's slowly going underwater. We have these crazy hurricanes, and our prayers go out to all the people that have been affected and all the families that, they were saying it could be the craziest, category 5 and be bigger than the model that was, that's coming in, and it's creating massive destruction and devastation all across different parts of Florida. That's climate change. Why? Because the Gulf was just hotter. So it rolled in harder. Climate change, I think, is going to continue to affect housing. It's going to continue to affect the coastal areas. But it's not going to dramatically affect prices except for in maybe select markets. So if we're looking at the U.S. nationally, not much change. Some markets, yeah. Is it going to cause some people's interest or insurance to be like stupid expensive? Mm-hmm. Absolutely. Next, we got tech and unemployment rates. So in the great financial crisis, there was these rumors, hey, we're going to lose all our jobs to overseas. And I think today, now everyone's more worried about, hey, we're going to lose all of our jobs to AI. The longshoremen just went on strike because, they were worried about all the jobs being automated away. The unemployment rate in 2007 was 4.6. The unemployment rate in 2008, 7.3. We talked about this before. It peaked at 10% and then went to 9.6. Well, what was it right after COVID? Well, it was 6.4 in 2021. 3.7 2022, 3.8, and today it's at 4.1. So our unemployment rate is so much lower than it was during the great financial crisis. See, one of the things that people say is, I want home prices to drop. Nobody had a job. An unemployment rate of 10%, nobody had a job. Today, we're very highly employed. Now, arguably, though, some people do have 2 jobs, and we do have a lot more of that gig economy. What's your feeling on that?
In terms of unemployment?
Yeah, and how people feel.
Well, I think that unemployment is not as low as it could have gone because of the massive amount of stimulus.
Yeah.
Massive amounts of welfare state regulations. For example, rental. Like forgiveness, or you don't have to pay rent for almost 2 years? Yeah. Almost 3 years. So unlike the great financial crisis, they didn't have those kind of things. They were literally booting people out of their homes, and there was definitely no kind of cushion for people.
Same thing with foreclosures.
Yeah. And then also when it comes to jobs, we didn't have these gig economy jobs back then, or as many. I don't even know if Uber was a thing yet, really.
No, it didn't exist.
It was just for private drivers, and it was just more of a way for them to streamline how they got their clients when they're picking them up. Like town car. I remember getting picked up by somebody in a town car in New York City and was using an app. I was like, oh, what is that? It's like, oh, that's just the way we get our rides now. I was like, oh, that's cool. And that was early Uber. In fact, it might have actually been Uber, but it wasn't called Uber. So what I'm trying to say is the environment is so different. It's almost as if we're living in la la land of the Fed
Yeah.
and stimulus, welfare state, and everyone else is paying for it. Everybody through inflation. So that's why it was joking, but also serious about how do they fill out these surveys. I don't even think it's really representing correctly how people actually feel, generally speaking, on average throughout America.
Yeah, because it's only 3,000 people.
Yeah, and that's, I guess you could say that's always been the case. What's
Yeah.
3,000 people? But then maybe people just aren't paying attention. Somebody said something to me recently about the news, okay? Set aside how you feel about the news. Back in 2010 or prior to 2010, everybody watched these news channels.
Yep.
And they just served you the news of the day, news of the week. And for the most part, it was not very biased. It was biased a little bit, but not a lot. It was just like they had to compete for your attention. Like, hey, this is the news. Well, in 2024, we definitely know they are biased, but they're biased because they need to get your attention. Because what they're competing against is the internet and social media, which completely just gives you exactly what your, monkey brain wants.
Yes.
The most convenient, entertaining thing. We're living in a completely different reality. The numbers and the reports and the way we gather the data, it might be archaic.
It's very archaic.
Right? So
Yeah.
these people who are doing the gig work, living on their phone, and just living in their own matrix.
Yeah.
Okay? We don't know what they're feeling, but the only way you know is you talk to people. Like the person that talks to the most people, like the most different types of people, I would believe that 100x more than I would believe anything the government reports.
Absolutely.
So my thought is when I'm listening to all of this, putting it all together, because uniquely you and I both lived in the great financial crisis and we just lived through this, and we were both geeks in both eras, paying attention to it. I remember watching. I'm not even a stock marketing guy. I was watching it every single day. I'm not even a numbers dude, but I was paying attention to the Federal Reserve, interest rates. I was watching every single movie about monetary supply back then.
Yeah.
And then I started caring about gold, about the value of money, the value of assets. And this is when I got into real estate. And then I did all those same things in 2020, and I could literally compare. So everything that you're doing, though it's way smarter and it's way more detailed, I'm looking at it from a perspective that they're the same eyes doing the same thing, but the numbers and everything's all skewed. Everything. And even, in fact, if you think about it, everything that happened, all their moves were just like great financial crisis moves done a little bit ahead of time.
Yeah. This is history repeating itself, history rhyming.
Mm-hmm.
So we need to be careful when we say this time is different. But if we look at the pattern is the Fed raises rates, the economy and real estate slows down. It doesn't mean it crashes. And the problem is because the great financial crisis is so close, people assume real estate crashes. There's nothing to support a crash in the data. We've already had the slowdown in prices. We already had the crash in transactions. But then prices stabilized and they started growing from there. Next item on the list, new forms of debt. So during the great financial crisis, credit card debt became the big bad wolf. And then, of course, we talked about the ninja loans, the subprime loans. So those were our bad ones. Today, it's the buy now, pay later and student loan debt. So I went and looked and tried to figure out, okay, what's household debt look like on these two? And then what's equity look like on these two? So we could kind of compare it. Household debt peaked in $12.7 trillion in 2008. And mortgage debt in 2008 was $10 trillion. Credit card debt reached $870 billion. But the delinquency rates, because like you said, There was no, we're not going to foreclose on you. It was just legit. It was real. These were the real foreclosures. Hit 10% by the end of 2009, and then they just started foreclosing on everyone. That became that tsunami. So if we flip it over to today and look at 2024, household debt's grown to $17 trillion. Holy Toledo. Mortgage debt, interesting. Mortgage debt, the largest component, is $12 trillion, so it's only $2 trillion more than 2008. Credit card debt reached $1 trillion. Oh my goodness. Auto debt surged to $1.6 trillion. So look at that. Auto debt doubled. Auto debt still got problems. Auto loan delinquencies today are through the roof. If you go look at the Manheim used car index, you can see it go shoot up, hit a ceiling, and it's literally coming back down to the trend line. And because banks did this and over leveraged and allow people to over borrow, this one has to work itself out. Delinquency rates today, though, 2 to 3%. What's the key difference? The key difference is, like, even though debt is higher today in nominal terms, nominal just means like the number, it's actually lower today than it was during the great financial crisis as a percentage of income due to the stricter standards. So that house of cards, the dominoes that we had happen, it's not happening right now because technically, even though the consumer has more debt, they're actually less leveraged. Does that make sense?
Mm-hmm.
They're less leveraged. So when people say everyone's in so much debt, home prices has to drop, the consumer's less leveraged. Okay, well, let's look at home equity then. Maybe it's home equity is going to be the problem. Maybe that'll finally take everything out and cause it to crash. Okay, so by 2009, total home equity fell $6 trillion from its peak and created those underwater homeowners. We had 3 million homes get foreclosed on from 2007 to 2009. Okay, well, where's home equity today? Home equity is at a record $30 trillion more than the great financial crisis. Home prices surged. Now, this is the problem, though. This is the unaffordability. Over 30% across the U.S. Foreclosure rate is currently less than 1%. So today, yes, consumers have more debt, but it's less of a percentage of their income. Consumers have more equity, and consumers have just a little more housing debt. But overall, because the equity is so big, they're fine. So what's going to keep this really high? And we mentioned this briefly, but I want to go into the exact numbers on new construction so everyone's on the same page. 2005, we peaked and we built 2.15 million homes at the peak of the housing bubble. And then 2006, we started declining. We built 1.6 million 1.8 million permits were issued. So in comparison, from 1960 to 2000, we only did about 1.5 million annually. Then the bubble pops. You can go look at this data. It's right on the Federal Reserve's website. You can see we issued 900,000 permits in 2007 and then 500,000 permits in 2009. So we go from a peak of 2.15 million to 500,000. Housing starts in 2008 fell to 906,000, and we were starting over 2 million homes at the bubble in 2005. So one was permits, this one's housing starts. So then what happens to the new construction supply? New construction, because the banking industry crumbled. So I became the repo man, the hatchet man. My business in the early 2000s, I'm working for investors, builders, developers. That is like 60, 70% of my business. And I'm learning my craft that I do today. Then in 2007, the lights get shut off and my personal lines of credit start getting shut off, and all the builders and developers I'm working for, their stuff starts getting shut off, and it becomes a major problem in 2008. By late 2008 here in the Seattle Metro, in early 2009, I am now on the other side of that equation, working for banks, going back to those same investors, those same builders, those same developers, and saying, I'm sorry, homie. I need you to give me back that plat. I need those 12 lots. By the way, I'm going to need the title to your motorhome. I'm going to need to cross-collateralize this against your house. I'm going to need to cross-collateralize this debt against your duplex, and I'm going to take that over there too. I'm sorry. So I literally went to being the hatchet man. And then we did a whole bunch of foreclosures, and you and I had a lot of fun during that era. What happened, though, is the builders and developers, they just stopped building. So new construction is 600,000 to 800,000 units a year for the next few years. 2013, 2016, we're barely above the great financial crisis, and we get to 1 million to 1.2 million units. In COVID, we come out with 1.38 million unit starts. And then in 2022, we get 1.55 million. And in 2023, we get 1.4 million. So for full perspective, from 2008 to 2023, we built roughly 15.5 million homes. Pre-Great Financial Crisis, we were doing 1.5 million homes a year, and we built 17 to 20 million homes. That means the shortfall was 2 to 4 million homes less between 2008 and 2023 compared to the previous decade. So this is why when I say we haven't built enough homes and we're too far behind, this is the quintessential kicker. The low estimate by The Economist is 1.6 million units. The high estimate is 6.5 million units. So anywhere between 2 to 4. With artificially low supply, because the Fed took it away from you with their high rates and their monetary policy. So when I say the Fed broke housing, this is what I mean. They broke housing because new construction stopped. Therefore, prices have to keep going up because people still moved to the United States and we still made babies and our population grew even while we were 4 to 6 million units behind on housing. Thoughts on that, brother?
It's looking pretty gloomy.
It's not gloomy, but that's what forces prices to keep rising. That's the whole hypothesis here. When we compare the great financial crisis to today, things were so much worse in the great financial crisis, and now we're so many million units behind. Prices have to keep rising just due to the lack of supply. This is simple supply and demand economics. Okay, they already went flat. We already went to less than 4 million homes sold. Home sales is going to go up as the Fed continues to cut rates. It may not be perfect. There may be bumps in there. It may be a soft landing. It may be a semi-hard landing. Home prices should still go up during that process, though. Just because you're so many millions of units behind. That's what's crazy. Thank you, everyone, for listening and hanging out with us. Please subscribe if you're not subscribed, and leave your comments or questions below.